Well, good morning and welcome to another Simply Tax Talks here. We're excited to have you again back this morning. Again, the point of all this is to kind of help you, deal with and digest all the things that are coming at us from a tax landscape. We've obviously talked a lot about the Build Back Better, some of the legislative buildup. Maybe things we were talking about last week are on pause, but we'll see, as they say, as we get to our update with Yelena and the group here. But I'm also excited because maybe there's some uncertainty, in some certain areas with legislation and so forth, but there maybe is one thing we do know, and that's some of the changes that we've had as a result of actually going back to our last tax reform efforts, the TCJA. And we've got a special guest here today, our new leader of our research development tax credit practice, Mike, joining us here. So excited to have him on board as well. Obviously have Tad and Yelena as well. So welcome to all of you today. Let's jump in with our top tax topics of the day. All right, Yelena, I'm going to go to you again, as we typically do right out of the gate here with what's going on in Washington. What do we need to know that might impact taxpayers and businesses here?
Yeah, well, there's not much to update, honestly, because Congress was out on recess last week. And so it's been kind of quiet, but we do hear that everyone's kind of back and optimistic that they can restart negotiations. Of course, anything that's going to be passed is going to look very different, like we've talked about, than what the House passed, because there's just not the support in the Senate to pass the Build Back Better Act as it passed in the House. And so we'll see a scaled back version, maybe piecemeal bills. We're still not sure what it's going to look like, but the biggest topic, I guess, that we've heard about the last few days is the child tax credit. So Manchin wants it to be lowered for income thresholds and to have a work requirement added to it. And there's been some support on lowering the income threshold for it, but no support for attaching a work requirement from other Democrats. And so a group of Senate Democrats actually wrote to Biden and said, hey, make sure this is added in somehow and whatever gets passed eventually. But again, there's not that support that's needed to get Manchin on board for the child tax credit. And so that's something that we've been seeing a lot of politics, I guess, going around, a lot of quotes going in press conferences about how to get the child tax credit, including whatever is passed. But progressive House Democrats want something passed by March 1st, which is when Biden's going to give a State of the Union. But obviously that's coming up here in a month. And I think most Democrats think that's a little bit ambitious, especially considering they have government funding to address in February, and they still can't get to 50 votes in the Senate on most things. So we're watching and waiting and seeing where things go.
Yeah, but again, you mentioned the same name. It's going to always watch what Senator Manchin is doing, perhaps. But yeah, the conversations around obviously they're back in Washington this week. Congress is back, but it sounds like maybe focused around the spending ultimately here. Is it February 18th? Is that the date there that we're targeting?
Yes, February 18th. So they had passed a stopgap funding measure, and that runs out February 18th, which means they'll have to either pass another stopgap funding measure, which I think this would be the third one, or actually fund it for the entire fiscal year. And so I think the goal is to hopefully go an entire year this time.
Okay. All right. Well, as always, Yelena, we appreciate the updates because it's just, there is a lot going on, even if it's not necessarily moving forward, kind of knowing where things are going and, counting the votes as Travis Lucas would always say, and making sure we kind of think down the road of what we might see. So I guess with that, again, I teed it up at the beginning here. We've had so many changes lately that it's almost hard to keep track of them, but we did, and we still do have some changes that are kind of scheduled to come into play regarding the TCJA, or the Tax Cuts and Jobs Act that we had enacted at the end of 2017. So I guess, Mike, maybe before we jump into that, just maybe a little of who you are, and then what am I talking about here with these changes that come into play?
Thanks, Damien, and it's great to be here with you and the team. So again, I'm Mike Bowenzi. I'm the firm's new research and development tax credit practice leader. I've spent over 20 years in the space, assisting clients across all different industries, large and small, implement and document the research credit. One of the more significant changes that came out of TCJA in the R&D credit space was the sunsetting of the ability to currently expense research and experimentation costs, and the requirement to now capitalize these costs. And if folks may recall, this was one of the pay-fors in TCJA in exchange for lower rates. And since the passage of TCJA, I think the issue has largely flown under the radar screen for many taxpayers. I think first because it had a delayed effective date, and then secondly, many believe that Congress would pass a fix and repeal this rule prior to its effective date, or at least delay its effective date. Well, 4 years has gone by awfully fast, and here we are sitting in February of 2022 with this law change now effective for tax years beginning after December 31st, 2021, which now requires businesses to capitalize and amortize its US-based research and development costs over a period of 5 years and non-US based research and development expenses over 15 years, which if you actually read the statute, it's 6 and 16 years because the amortization begins with the midpoint of the tax year in which the expenditure is paid or incurred. Now, up until this point, taxpayers have had the option to adopt a method to either currently deduct or capitalize and amortize these costs. I will say that, this is an issue that's going to impact at a minimum every company that claims the research credit, and really any business for that matter that develops new or improved products. This is because by definition, any costs that are included in the research credit must now be treated as 174 expenses and covered and recovered over at least a 5-year period. So why is this so significant for taxpayers? Well, for starters, there's cash flow planning. Certainly this change has the potential to materially impact estimated payments for 2022 and beyond. There's certainly international implications with the allocation of R&D costs for FDII purposes and foreign tax credit calculation purposes, as well as BEAT. And certainly from a state tax perspective, there's going to be a cash tax impact, right? And also conformity issues that will likely need to be considered. What's also significant here, and I want to make this point, is that any and all software development costs, regardless of whether the software is internal use or external use, are now governed by this new amortization rule. The reason that's significant is because historically taxpayers have been able to expense software development pursuant to the guidance under Revenue Procedure 2000-50. And the last point I'll make is that, in my experience, the challenge for taxpayers in complying with this new rule change lies in the fact that the activities and the costs of what fall within the definitional scope of Section 174 are much broader than that for the research credit. And what I mean by that is Section 174 includes any and all activities and any and all costs that are incident to the development or improvement of a product. And so a likely scenario could be that a business's 174 costs could potentially be much larger than the costs that are credit eligible under Section 41. And so to the extent a business has not begun to plan or model or evaluate any of these impacts, or develop a process to efficiently capture and allocate these costs, now is really the time.
Yeah, and I guess it has an instant impact, I guess, especially those that are corporate taxpayers, right? Because you're starting to think about what that means. But if you're somebody that's trying to wrap your head around it, maybe you haven't really thought about it yet. What's your advice? How do you approach it, and when is it going to start to really impact?
Well, again, I think, for purposes of estimated payments for 2022, to the extent companies have not begun to look at this issue in conjunction with looking at and analyzing costs that could potentially be eligible for the research credit, it's more than likely now that taxpayers are going to be required to examine additional costs outside of the amounts that are included in the research credit. So and oftentimes I get the question, well, can't, taxpayers just use the amount of costs that they claim for research credit purposes and use that as their 174 deduction / amount that needs to be amortized? And the answer to that is really no, because as I mentioned before, Section 174 is much more broad, so it can include overhead, things like rent and utilities, depreciation, patent fees, foreign research costs even. And so if, now is the time to start to cast the net a little bit wider and maybe expand the analysis around the research credit to include maybe a closer look across the organization at just what expenses would fall within the purview of Section 174.
Okay. And so, we oftentimes are talking about the R&D tax credit in that practice. So maybe, what's the interplay here? And I'm also probably going to ask you, it's a favorite question I always like to ask when dealing with complex areas of the tax code of, kind of what is the R&D tax credit, if you had to explain it to me, in an elevator ride on the way up to the office in the morning. What's the interaction and really what is the credit there?
Yeah, absolutely. So because of the direct relationship between Section 174 and the R&D credit under 41, any costs that are claimed towards the R&D credit must now be treated as 174 costs on a taxpayer's return in order to be eligible for the credit. Now, that's a significant change because historically, some taxpayers may have included costs for the research credit that were claimed elsewhere on the return, say, for example, as a ordinary and necessary business expense under Section 172, or perhaps buried in cost of goods sold, right? So this has now become an issue that taxpayers have to take a closer look at, not to mention the location of where the research is being performed, whether it's domestic or being done offshore. In addition, as businesses work to identify their 174 costs for purposes of compliance with this rule, they may in fact identify additional costs that may qualify for the credit under 41. And then lastly, I'll say when claiming the credit, many companies oftentimes make what's called the 280C election to claim the reduced credit. This election is made in lieu of reducing the deduction for your research and development costs on your tax return. And while this is often a facts and circumstances determination for companies as to whether it's beneficial to make this election, theoretically, a company may not want to make the reduced credit election because the costs that go into their research credit are already being added back vis-a-vis the required 174 capitalization rule. And then as far as, what is the R&D credit? Very simply, the research credit is an activities-based credit, I would say, that rewards evolutionary development. So companies or businesses need not be developing products that are revolutionary to the industry. Any business, regardless of industry, that is developing newer improved products, processes, software, methods, techniques, patents, or custom machinery and equipment can qualify for the credit and recoup anywhere between 13 and 20% of its credit eligible spend. The other thing I'll add too is that companies can secure credits not only for the current year, but all open tax years as well.
Okay. Yeah, it's good to know, right? And you can go back and actually I know in one of the resources we have posted here in the comments, right? They recently changed kind of what you have to attach and how you show your work on doing those claims. That's a great point, right? It's a huge opportunity. And I'm always interested in this, and I'm curious your take here, Mike. What's been going on from the exam side of things, and maybe what we're seeing in that environment.
Yeah, absolutely. Happy to share some thoughts on that. I would say, generally speaking, over the last few years, I have seen somewhat of a dip in IRS exam activity in regards to the credit as compared to historical levels of exam activity. Keep in mind, my point of view is over a 20-year period. And I think that's largely driven by resource constraints within the IRS, an internal reorganization that the agency has been undertaking, as well as obviously the impacts of the pandemic. I will say, though, I think that tide is turning because over the last year, I've begun to see an increase in exam activity at both the federal and state levels. And I think the frequency of published court decisions in the R&D credit space over the last year or two, combined with the addition of Section 174 and 41 to the IRS's list of published compliance campaigns, combined with the recent hiring of an additional 40 engineers to work on R&D credit cases, at the federal level, with the plan to hire an additional 70 engineers nationwide, signals two things. The first is I think the IRS is more confident and willing to challenge taxpayers on a broader spectrum of R&D credit issues. And the second thing is I think examinations of the research credit are all but certain to increase. And so maybe I'll just take this time to highlight a couple more significant emerging trends that I'm seeing in the R&D credit environment. And the first has to do with the allocation of costs to what are called business components, okay? So let me provide just a little bit of background. So the four-part test for qualifying research is to be applied at the new or improved business component level. So what is a business component? Well, it could be a product, it could be a process, a software, or any item that's held for sale or used in a taxpayer's trade or business that is the subject of research. And so recently, I've been seeing exam take the position more and more that unless a taxpayer can identify, each business component that forms the basis of its credit claim and the associated research expenses, then taxpayers fail to comply and cannot claim the research credit. And I think much of this viewpoint, as you alluded to, Damien, manifests itself in the recent guidance that was contained in the Chief Counsel memo that was issued in October of last year, and the related FAQs requiring certain minimum information to be included in R&D credit refund claims on amended returns. Now, what I will say is that there's no requirement to have project level accounting for taxpayers to avail themselves of the credit. And Congress has clearly said that the credit should not be intended to be contingent upon unreasonable record keeping standards. But I think it's important to emphasize to our audience and for the audience to understand that credits are a matter of legislative grace. The burden of proof is ultimately on the taxpayer to substantiate their entitlement to the credit. So for those taxpayers that use a pure, what I would call activities-based methodology, where let's say, for example, a simple qualified percentage is applied to employees' wages as an example, without identifying the projects the employees worked on, nor make reasonable attempts to identify the costs of developing each business component, that fact pattern has caused headaches for taxpayers in exam, resulting in some cases in significant proposed credit disallowances. And I think it's too early to tell if exam's business component argument will gain traction, with appeals as an example. So more to come on that. The second issue I did want to quickly highlight that I'm starting to see more and more in the exam environment deals with the fourth test of the four-part test, and that is the process of experimentation. So one of the four criteria that activities must meet in order to qualify for the research credit is this process of experimentation test. And so for taxpayers to meet the criteria, when developing a new or improved product, they must demonstrate that substantially all of the activities that are performed, and that's defined as 80% or more, constitute a process of experimentation. And there was a recent court case from February of last year. It was the Little Sandy Coal versus Commissioner case that involved expenses incurred by a shipbuilding company, where the court concluded that the taxpayer failed to provide evidence of the portion of the activities that did or did not involve a process of experimentation. And so when you think about this 80% rule, right? Think about a fraction where the numerator contains only activities for performing direct research, and the denominator includes all activities: direct research, direct support, and direct supervision. If that ratio is at least 80%, then the taxpayer has substantiated that it meets the process of experimentation test for any given project. Now, I've begun to see more and more IDRs from the IRS in exam situations requesting taxpayers to provide evidence that research activities meet this substantially all rule. And so what I would suggest and advise our audience is that, how a taxpayer classifies employee activities as direct research, direct support, or direct supervision is really crucial. For example, how would you classify a production worker who participates in running a test? Is that direct research or direct support? Or how about a supervisor that splits his time as a direct contributor versus supervising others that perform research, right? Achieving a functional understanding of the activities that are performed by various departments and various job titles within the organization is very, very important.
Yeah. Mike, I honestly think, and we were chatting about this a little bit earlier about that. We're gonna need to get you on the podcast and dig deeper on some of these things because, man, I'll tell you, there's just so many questions I have for you here. And again, if you're in the audience and you're watching, Mike clearly he knows his stuff and has the perspective that can help. So get your questions in if you have them. We're gonna do that follow along episode, Mike. I'm real happy to have you on the board on board and happy you could join us here today. But as we often do, we like to get Tad's takes on things. And so I guess let's do our next segment here with Tad's takes of the week. All right, Tad, what do you got for us?
More in the realm of the compliance. We're kind of getting into the start of the tax season and getting the returns done and a lot of the pass-through returns. And one of the things that we received yesterday, thanks to both Craig Kuchenberg and Chris Clifton, are some real detailed information on the new K2 and K3 reporting. This is something that is kind of snuck up on us a little bit, for the 2021 filing session or season, or the K2 and K3, which goes along with the 1065 and the 1120S reporting. But Chris and Craig put in a ton of work, and the templates that are out there. This was all sent out to tax directors last night in draft form, but they're expediting getting this stuff posted into the KeyNet site. So one thing, if you're working on some of those returns right now and you're seeing K2 and K3 and it looks really foreign to you, because it is, it's something completely new dealing with international reporting. So just know that there's some templates that are coming out there, and I took a quick look through them last night, and I mean they're going to be a big help, to the people that are actually out there preparing those returns. So keep an eye out for that. You'll probably be seeing some of those here yet this week, coming out.
Yeah, there's a lot there. And for those, that are having to, if you're filing or if you have somebody and we're helping you with a pass-through return, there's just these new schedules that even if you don't have the international filing requirement, it may seem not like you wouldn't expect it, right, Tad, that you can end up having to include these schedules.
And then that's, I mean, in bold red type, you'll see in some of these, there's actually two memos that are coming out with it that were posted, but that both Craig and Chris are very, very adamant to, don't just mail it in, think that you don't have it, that you don't have to do anything with those K2 and K3. Now, there are certain circumstances that, you have a lot less reporting, but there still is reporting that has to take place there. So just keep an eye out for that stuff, and it will hopefully make things a little bit easier too. But, they just did a whale of a job with that. Both Chris and Craig did.
Yeah, absolutely. Yeah. What else are you watching here, Tad?
Well,
we got schedules.
It's nice to have Mike on board. Mike is not only kind of with the R&D credit stuff, but he was also been heavily involved with the retention credits, and we've been talking about that a lot lately. Not so much in the realm of being an eligible employer because you met the revenue reduction, but it's that other very, very subjective test of your full or partial suspension of your business activities due to government mandates. That area is getting a lot of play right now, and I know Mike's seen some has seen some things from other pop-up firms, I guess I'll call them, that are making some representations out there that we just can't get there on. But there are some areas in there where people may not have thought they were eligible for the credits, but actually are. So I would just throw that out there as as we go through this compliance season, people out there preparing those returns, take a look to see if they've got any retention credits out there. If anybody's looked at them, they might actually fall into the revenue reduction. which is, a lot more objective of a standard. So, Mike, if you're out there, maybe kind of give us a bit of an idea of what you're seeing out there, what you have seen in terms of that subjective qualification of the full or partial suspension.
Yeah, absolutely, Ted. So let me just provide some perspective. So in my experience, in working with clients relative to the employee retention credit, a majority of the clients actually that I have worked with have qualified for the credit under the government order test and not the gross receipts test. And again, as Tad had mentioned, there's two tests that have the potential to get a business to eligible employer status, and a business simply has to meet one or the other. It's an or test. It's not an and test. And so, for the more subjective facts and circumstances government order test, what that basically says is a business that has experienced either a full or partial suspension of its trade or business operations of more than a nominal portion of a company's business, which is a pretty low bar to meet, due to either direct or indirect impacts of various government orders, can get to eligible employer status. Now, what are some examples of that? Well, examples that I've seen of impacts of government orders include things like shutdowns or closures, partial suspension of operational activities, reduced production volume, employee hours or shifts that have been reduced, employees that are unable to perform duties, let's say, or working less hours post-COVID than they did pre-COVID, employees that are experiencing challenges working from home when normally they work on premises is another example as well.
Yeah.
And also, I'll just add a couple other examples include, more of an indirect nature that I've seen get businesses to eligible employer include suppliers that have been shut down or have some way limited operations, or there's been supply chain disruptions, customers shutting down, canceling orders, or in some way limiting operations. These are examples of facts and circumstances that are helpful to a company qualifying for the credit based on a full or partial suspension of trade or business operations.
Yeah, I think the thing that we're seeing out there a lot, though, is, that's kind of, round two, the second thing. But the first thing that we have to have is there has to be the government order, the government mandate. That's the key that,
Right.
gets them to that second step about then what effect did that have. So,
Right.
We're seeing some things out there that, maybe taking some liberties about what a government mandate or government order, may or may not be. And, we've had some conversation with clients about, how we view some of these things versus maybe how some other firms may be looking at them. So, but anyway, I think the retention credit thing, I don't think this is fully played out. Damien, you asked a question earlier, to Mike about, what he's been seeing in exams and, for the R&D space. But, we're going to start seeing a lot of exams come out here in this retention credit because there are some huge numbers out there. And I think the way that the service is probably going to take a look at that, they're going to look at Nexus codes because they're going to be able to, cross-reference what Nexus codes are essential businesses, which ones are not essential businesses. Not that you can't qualify if you are essential, but there's just a little bit more difficulty. So I think we're going to see a lot of that. I know that there was one of the IRS people, was speaking at a conference, and it said that they were training their people and were looking to hit the ground running in February and March, for doing these exams. So it's going to be interesting to see if some of these ones get pulled that we think are maybe a little aggressive, and to see what happens with them. Again, if for some reason that they are judged to be fine, then we still have plenty of time to go back and to file amended returns, if we have some other employers that we think that are going to qualify. But I just don't think I want to be a guinea pig on these things.
Yeah, that's a great point. I don't know, Mike, maybe any thoughts there on just even preparedness for that if you've taken a position and whatnot, and getting ready for maybe questions down the road, perhaps?
Yeah, absolutely. I mean, I think it's incumbent on all taxpayers that have claimed this credit to really ensure that they've dotted their I's, crossed their T's, gathered all the facts and circumstances to support either a direct or indirect impact on their organization. But as Tad had said, tie it to the government orders that either directly or indirectly impacted the business. That is the critical piece. There has to be that nexus there in order to support a claim for credit. And as Tad had said, I wouldn't be surprised if we see the IRS add the retention credit to its IRS compliance campaigns here in the next 12 to 24 months as it ramps up resources around the examination of this issue.
Yeah. Yeah, it'll be interesting to see. And we have a live poll up right now, and always again appreciate your input. And I know I've been having a lot of conversations. I'm sure Mike, Tad, Elaine, I'm sure you're having similar conversations around people waiting for refunds. So be curious your take as the audience here. But yeah, just a lot of things to keep your eye on. So maybe we'll do just a quick round the house here, and we'll do our top takeaways from this week's live stream. Elena, I'm going to go back to you. What's your top takeaway thing that you're watching for this week ahead?
Still the same thing I say every week, which is sound clips from Democrats in the Senate, mostly, especially Senator Manchin, because everyone else could say what they want, but Manchin has been the holdout this entire process. So just watching and listening for that.
Okay, so keep an eye on Manchin over here. Okay, Tad, what are you watching? What are you looking for this week?
Actually, it's more internal this week. Looking to see a lot of returns start to come through for the review process and see how some of the different offices might be handling the K2K3 and some of the other new schedules that have to be attached, like the 1061 information. So just kind of, getting down the weeds into kind of what we do.
Yeah, no, it'll definitely be interesting. And just, again, for those that just appreciate the amount of work that goes into this, right? I mean, there's always something new, and we got new schedules to deal with here. So absolutely appreciate you. Well, appreciate all of you, but appreciate you, Tad, for your help there on that piece. But Mike, yeah, well, what are you looking for? What's your takeaway, your leave behind here from our conversation today?
Yeah, I think as clients and businesses start to get into the compliance season in the thick of things now and start to really look under the hood as it relates to their research credit, I'm looking forward to have more discussions with not only our teams but our clients, just in terms of how we can help them start to think about and put a process in place around this 174 capitalization issue. As I said before, I do think this is going to be a big issue that hasn't received a lot of attention, generally speaking, within the business community. And I'm looking forward to seeing and having more discussions on that topic.
Absolutely. Yeah. Well, I will say that my takeaway here is, like I was saying earlier, we're going to have a podcast conversation a little bit more in depth, right? Because I think you're right. It's just starting to get on the radar of many, but it can be pretty impactful. And actually was having a planning meeting, getting ready for one, I should say, and noting just how significant that will be for one particular taxpayer that I personally work with. So it can be very impactful. And yeah, so let us know what questions you have. In the chat, obviously we've got the contact information for Mike, for Tad, Yelena. We've got it in the comments or the description as well. So reach out, let us know. That's really why we're here. That's why we're doing these live streams is to help you. So make sure you subscribe if you haven't already. Next week, we'll be back again and with another update on where things are going and where things are heading. But until then, I guess, thanks for watching today and have a great week.